Hello, everybody. My name is Dr. Andre. I'm Senior Research Officer here at the Wilfred Martin Centre for European Studies in Brussels. And I'm very happy to be here today to moderate our discussion on financing freedom, strengthening Ukraine's economic resilience in the future. This event is being live streamed on our website, martincentre.eu, and also on YouTube. For those not watching live, this event will also be placed on playback on our YouTube channel in the coming days. For those of you who are watching live today and who want to ask questions, please don't hesitate to send us questions via Twitter to @MartinCentre or @Andre, and we will get to them if we can. We only have 60 minutes to discuss a lot of big, very important topics. So let me just start by introducing our panel of experts. From Ukraine, we're delighted to have Sergei Nikolaishchuk, who is the Deputy Governor of the National Bank of Ukraine, which of course is Ukraine's central bank. We are also joined from Ukraine by Olena Bilan, who is Chief Economist at Dragon Capital, a Ukrainian investment bank, and she's also a member of the Board of Directors of the Kiev School of Economics. And from Berlin, we were just joined by Professor Albert Ritschl from the London School of Economics. He is actually at the event, at the conference in Berlin today, discussing Ukraine's reconstruction. And I think it's fair to say that he is an expert in the recovery and reconstruction of post-conflict economies. At the start, I'm just going to give each of our speakers maybe 5 minutes, 5 to 7 minutes, just to set out some key issues as they see it as we move forward with the Ukrainian economy and hopefully with the Ukrainian recovery. I will jump in if there are any technical problems, etc., with my colleagues Jamel and Sandra. So I suppose just to give a very brief bit of background. In Brussels, the debate tends to be on two things. It tends to be on armaments, getting armor to Ukraine, and it also tends to be on the long-term reconstruction of Ukraine. But also, I think there is a shorter, medium-term consideration which has to be discussed, which is facilitating Ukraine's financial stability to allow that reconstruction really to take place over the longer term. So the whole point of this event is to discuss how the macroeconomic conditions are at the moment in Ukraine, what are the prospects, and I suppose what can we do working within the EU to force the EU into its strategy over the coming months, years, and even decades. So with that, I would like to pass over to the Deputy Governor. Deputy Governor, the floor is yours.
Hello to everyone. First of all, thank you very much for inviting me. That is my great honor to speak at this event and share my views on Ukrainian economy and NBU's policies at these challenging times. And as you know, Russia's full-scale invasion has affected our country in a multitude of ways, including through creating a humanitarian crisis and active migration abroad. And this will influence Ukraine's demographic development and labor market conditions for many years to come. The latest estimates show that around 7 million Ukrainians remain abroad, and the number of internally displaced persons is almost the same. Also, in addition, even before the latest missiles and drones attacks, the estimates of the direct damage done to Ukraine's civilian infrastructure and other objects and of general economic losses were huge in the scale of hundreds of billions of dollars. And definitely all these losses of human and physical capital put enormous drag on the economy. Meanwhile, after declining steeply at the beginning of the war, it seems that economic activity has been recovering gradually, especially in the second and in the third quarter, with continued liberation of Ukrainian territories, businesses adapting to the new conditions, and the opening of the grain corridor, which allowed Ukraine to export grain from three of its ports. However, current logistical problems, the destruction of production facilities, and especially in the energy sector, and the decline in real household income are restraining economic recovery. As a result, we expect that contraction of GDP will be around 32% this year, and we will have only sluggish recovery during the next 2 years, again, conditional on the outcome and duration of the war. And let me now describe the NBU's policies in this challenging environment. Actually, our first steps after the Russian invasion were directed at preventing panic and disruptive behavior, ensuring the uninterrupted functioning of the banking system and payments, keeping the economy running under an unprecedented shock, and reining in inflation expectations. For this purpose, in the first days of the war, the NBU fixed the official exchange rate of hryvnia to US dollar, through the use of FX interventions and also by introducing tough capital controls. The exchange rate started to play the role of nominal anchor for expectations and went on to become the main instrument for curbing inflationary pressures and ensuring macro-financial stability in Ukraine. The NBU also adjusted the operational design of its monetary policy, taking a set of crisis measures to mitigate risks to financial stability. Specifically, the liquidity of the financial system was boosted significantly. And due to the strong psychological pressure caused by the war, changing the key policy rate was unlikely to stabilize expectations and maintain control over inflation. That's why from February through March, the NBU postponed the key policy rate decisions, keeping the rate at the 10% level. In addition, in the earliest days of Russia's full-scale invasion, the NBU deployed a wide range of measures to support financial institutions and borrowers so as to stabilize the financial sector. Moreover, to ensure the uninterrupted funding of critical public expenditures, the NBU has been supporting the Ukraine's state budget via purchasing of the government debt securities. Sure, that mix of massive injection of liquidity via the budget and the banking system, a fixed exchange rate supported by interventions and capital controls, and a freezing of the key policy rate helped the banks, businesses, and households to adjust to the new reality in the short-term period, but this mix was not sustainable in the long term. That's why we started to adjust our policies as the failed Russian blitzkrieg moved to a war of attrition. First, the NBU started to withdraw liquidity support measures for banks. Then at the beginning of June, we raised the key policy rate considerably to 25% to boost the attractiveness of assets priced in the national currency and ease pressure in the foreign exchange market and on our reserves. Then, as depreciation pressure remained too strong to withstand, in late July, the NBU made one-time 25% adjustment to the official exchange rate. Relatively tight monetary conditions and this repegging of the exchange rate helped weaken the pressure on Ukraine's fixed reserves. And together with an acceleration of international aid inflows, this has helped us to maintain our reserves at a relatively comfortable level. All these steps allowed us to avoid monetary destabilization so far. In September, inflation in Ukraine stood at 24.6%. Actually, other countries have had far worse inflation during or immediately after the war. Taking into account the global trend of accelerating inflation, Ukraine's inflation rate can be considered as an achievement. But it's too early to relax. Ukraine has benefited a lot from the safety margin it accumulated before the war, but as winter draws near, we need to further strengthen the effectiveness of the redistribution of the domestic resources. And the easiest way to adjustment via inflation would definitely erode the household savings, deepen crisis trends and in the economy, and undermine social stability. So modern European history is full of lessons of the dire political consequences that can follow from unrestrained inflation. Instead, Ukraine should curtail the budget deficit by slashing non-priority expenditures and rising taxes. And also, Ukraine should revitalize domestic borrowings by issuing government debt on market-driven terms. And last but not least, international financial support for Ukraine should increase in order to support macroeconomic stability in this wartime period. Thank you very much. So that were my introductory remarks for this event.
Thank you, Deputy Governor. And I think you set out very clearly what actions the central bank has undertaken to stabilize the economy. You know, it's been, what, 6, 7, 8 months now, and it's still relatively stable, which, as you say, is an achievement in itself. But I think now, as we look forward, as you said at the end, we need to consider the longer term issues. Before I get to the Professor, I'll bring Elena in, maybe just to give a private sector view of how you view the conditions in the Ukrainian economy at the moment.
Yeah, thank you, and thank you for inviting me. I first of all would like to praise the actions and the response of Ukraine's policymakers to this unprecedented crisis. So that Sergei has explained in detail what the NBU has done. And I want just to emphasize that all these measures, that the first set of measures, they were imposed on the 9 a.m. on the first day of invasion, just for you to understand how quick the reaction was. And that really saved the banking system, saved the financial markets, and enabled the overall economy to run despite the full-fledged war. I actually can confirm from what I see from in our company and our partners, and based on business surveys, that the economy has been recovering since March. Definitely the depth of the economic decline is still very deep. It's about 35% year on year in September, but it is an improvement from probably 50% decline in the first weeks of the war and around 45 in March, for the whole months of March. So that unfortunately we don't have data for the real economy now because the statistical office stopped actually collecting and publishing a lot of economic indicators. So we rely on various surveys, and one of the surveys showed that actually in September only 8% of the companies on the Ukraine's controlled territory they were working below the 25% of their pre-war capacity, and this indicator was this share was 27% in May. And on the other hand, the share of companies that now operate at 75 plus capacity, it rose to nearly 50% from around 30%. So basically, that's a broad-based recovery that we are observing. The key drivers were that the businesses adjusted to shock, so that some of the territories were deoccupied, and also since August, the exports of grain has intensified thanks to the agreement that unblocked exports via Ukraine's Black Sea ports, and that helped to recover related sectors. Let me dig a little bit into the budget because this is where the problems are also quite acute. Because of the economic drop, budget revenues were also declined sharply, but at the same time, expenditures have increased. The increase in expenditures was solely due to military spending. Just to give you an understanding, before the war, military and defense, security and defense spending were around $1 billion or euro per month. Now it's nearly 4 billion euro per month. So it's a 4-time increase. And this is the main reason why Ukraine is running a very high budget deficit, which actually this year will probably reach nearly 30% of GDP. The government cut all the unnecessary spending. So what they really now finance from the budget is only this military spending, social, and some other critical. They continue servicing domestic debt, which is held by local commercial, mostly by local commercial banks, and that doesn't make sense to restructure it. But it restructured the external debt. Now there is no service or no principal payment on external debt to private creditors until mid-2024. So, but the overall budget situation remains very tough. So now Ukraine runs a budget deficit of around $4 billion per month, and the total funding needs are close to $5 billion per month. And definitely the foreign support is a key source of funding. I do agree with Sergei that there is some room for improvement on the side of the government in terms of kind of raising. They can raise more domestically, but this is not a significant amount that they can raise. Bottom line is that without financial support, Ukraine will not be able to finance its critical spending in a way that wouldn't endanger macroeconomic stability. So if there are not sufficient financing in the budget, so the government has to rely on the central bank, on money printing. And I totally agree with Sergei that we shouldn't underestimate the risk of inflation. A lot has been done to keep inflation under control. That was successful efforts. 25% inflation in the current global environment, I would say, is a huge achievement. But we shouldn't forget that this money printing is very dangerous, and the central bank has already printed $10 billion so far this year. So we should minimize this amount as quick as possible to sustain macroeconomic stability. And maybe my final observation from the private sector, I was very happy to hear from Dr. Andrea in the beginning that the discussion in the EU is kind of on this short-term and medium-term consideration is becoming more active, right? So, to be honest, businesses in Ukraine don't think about reconstruction much. So they really focused on today, on how to survive today, on where to get money to survive today, how to withstand those attacks on energy and the blackouts, and how to live in these conditions. So I would say from the business perspective, the financial support, short-term and medium-term financial support also to the private sector is much more important at this point than kind of the discussion about the long-term reconstruction prospect. Though I do agree that this is an important part and that it's better to have all the mechanisms and all the kind of procedures established in advance, but we also shouldn't forget about the today's situation and today's challenges.
Elena, thank you very much. That was very interesting to get a private sector perspective. Professor, you joined us just before we went live, so I gave you the opportunity just to listen to the other speakers. I think you are in Berlin at the moment. It seems to me that from all the Ukrainian policymakers and economists I know have a very good understanding of their economic history when it comes to war financing. I'm not so sure that EU policymakers have the same grasp on that history. So I'd be very interested to get your impressions about what's actually going on in Berlin, and what do you think the strategy should be for the future?
Okay. If you allow me, I will improvise a little bit. Because what I had brought along is not much. It's just a few slides on post-war recovery and the role of the Marshall Plan. And I would like to change that a little bit, if you allow me,
Sure.
and instead kind of connect more directly to the statements that I just have heard. So let me talk to you about what is going on in Berlin, but allow me to talk to you about what was going on in Berlin, let's say 105 years ago, because it might help a little bit to get the sense of perspective. First of all, it is of course not at all surprising that you had to resort to money printing to finance the war. You probably know this. Germany in World War I faced a bit of a similar problem, which was a collapse in output, a collapse in national income and a collapse in tax collection. It turns out this is not very widely known in the West, so I'm among those who have been kind of propagating that news, because it sheds a bit of a different light on German inflation. And I'm perhaps saying this also to offer a little bit of consolation to you. Because if you are in a situation of completely inevitable spending needs, which is obviously the case in Ukraine, and at the same time a collapse in tax collection, simply because the overall economy is suffering from war action that much, then what else shall you do? In the German context, it means we have a lot of literature that is criticizing the central bank's actions during World War I as being very irresponsible and very inflationary. I redid the numbers a couple of years ago and had the impression that given the pressure on the budget and the pressure on tax collection, the actions of the Reichsbank were actually overall pretty conservative. My estimate was that they probably monetized about 15%, that's 15%, of public sector borrowing, which would not be high. So inflation and the increase in the real quantity of money, or in the quantity of money over output, had to do with two things. One was the increase in money, and the other one was the decrease in output. And if I hear from you, as you both were saying, that we're talking about a collapse in output that initially was 50% and now has been brought back to 30%, which actually is a huge success. So congratulations on that spectacular recovery. But it clearly means this is not the time to go for rampant anti-inflationary policy. There's simply no way to do this. So my take on it would essentially be, and my question for you guys would be, what is happening, first of all, to tax collection right now, which is probably not great because business activity is not great. But second, what are the preparations that you can take in order to secure tax collection capacity and improve it for the day X when hostilities are over? It is very difficult right now, and certainly also emotionally difficult to even think of that moment, simply because we don't know when it is going to arrive and under what conditions it is going to arrive. But what I'm offering you by way of historical comparisons is about the following. Going back to the example of Germany in World War I, they realized they had an insufficient tax base, and were thinking about tax reform. That tax reform was then fully implemented only in 1920. with the Weimar Constitution of 1920, so-called Erzberger's tax reform. It did two things. First of all, it centralized tax collections in a formerly highly decentralized system. I don't know if that's a Ukrainian problem. And the second thing it did was to broaden the tax base as widely as one could, given the ideas prevalent at the time, and to make sure that there was an efficient tax collection authority with enough resources, with enough tax officers, and all these things. Interestingly, it didn't work. It didn't work, and it only worked after the end of hyperinflation, and that had political reasons. Political reasons like right-wing, left-wing extremism, reparation struggle, whatever. That's not really important. But what they tried to do was already trying to think about the capacity, the tax capacity in a future post-war period. And I don't know what concrete steps for you could be, but it might be a good idea to start, let's say, post-war planning now, if it's not done already. I would then, and that should be my closing remarks, I don't want to take too much of your time, I would then basically sketch two scenarios for post-war monetary stabilization. One would be to allow some degree of open inflation, like it was done in France and Italy after World War II. Cumulatively, price levels must have gone up, and please don't hit me if I get the numbers wrong, but I believe cumulatively the price levels went up by about factor 5 over pre-war levels. And I can go back and look at the numbers, but you can perhaps have somebody who does that too. It's a few websites to see what is. So they did not try to deflate. They did not try currency reform. They basically allowed open inflation to take its course and then to slow it down. The effect it had was to reduce the level of public debt relative to national income to a sustainable level. So fiscal theory of the price level in application, which means bring price levels to a high enough level to make things sustainable. A second scenario is West Germany's currency reform after World War II. It was a very, very harsh step, and it was a split level thing. Stocks of debt and bank accounts, all nominal liabilities, one-time nominal liabilities, were converted at the rate of 1 to 10, whereas recurrent liabilities like wages and rents would be converted 1 to 1. So they would change the relative price of one-time liabilities of stock relative to flows. That was extremely successful, but of course it was only so successful because there were Allied troops in the country. Sounds a bit harsh, but the Americans were there as an enforcer. So I'm not sure if currency reform in a post-war period is a realistic scenario. Last words, the fear of everybody, and this is something that people talk to me about all the time, is the risk of hyperinflation. And here I believe I have good news. Hyperinflation in Europe after World War I only started with a distance of about 2 years from the end of World War I, and is not a direct consequence of the war economy. Hyperinflation had to do with political chaos, domestic political chaos, what is nowadays called state capacity, the inability of government to perform its basic functions. I don't think that you're going to have much of that problem, because one of the amazing feats of your current war effort is the enormous efficiency of and the enormous solidarity in Ukrainian society. I'm sure this can be used to kind of carry over to the strength of the government and the public support it has. So hyperinflation, I believe, is not the danger. What you will have to do perhaps after a war is choose between open inflation that you then slow down or a currency reform. If you allow me a very last remark, and then I really shut up, is
okay, a very quick one. Yeah.
I'm more optimistic than you about the prospects of post-war growth. Post-war economic growth after World War II was in the 2 digits. Like think of rates of industrial output, of tax revenue, of GDP. It was growing at rates between 8 and 11% per year for a period of like 5 to 7 years. So if you get things right, I see a big chance for an economic miracle. I would not be pessimistic. I believe the real difficulty is how to basically keep the Ukrainian economy afloat until the end of hostilities, which hopefully will be marked with a full recovery of Ukrainian sovereignty over all its territories. Thank you.
Thank you, Professor. Very, very interesting. And I think your last point is the critical point for us here in Brussels at the moment, certainly within the EPP, is how do we keep the Ukrainian economy relatively stable until the process of reconstruction can begin. I think that might be the critical point. I would like to come back to the Deputy Governor just on the importance of foreign financial support in 2023. I was just wondering if you had any update on the negotiations with the IMF for a proposed cooperation agreement, or whether that is still ongoing.
Yeah, actually, the topic of shaping the macroeconomic policies to keep the economy afloat was in the center of the last week's discussions during the IMF mission, which took place in Vienna, as well as the topic of the next year budget financing needs. So during these discussions, yes, so we discussed details of the macroeconomic forecast, authorities' policies, and the parameters of the next year budget and the sources for its financing. No, actually, this discussion was the first stage in order to launch a new monitoring program with the participation of the IMF executive board. And so the main idea of this program, to have a plan to support macroeconomic and financial stability during the wartime, and again identify financial needs, enhancing the Ukraine's capability to raise funds from donors. And also, we suggest that this monitoring program will enable us to lay a solid foundation for moving towards a new full-fledged program with the IMF early next year.
Okay, Elena, I just have I'd like your comment on what's been discussed, but also I just had a question come in on Twitter that I think you might be able to answer. Is that in terms of existing Ukraine government debt, is it mostly held, by domestic banks, by domestic savers, or has it been internationalized in any way in terms of who holds the existing debt?
Oh yeah, thank you for the question. Just before I move to it, may I comment briefly or reflect briefly on what Professor Richel said. Well, I do agree and I do disagree in some aspects. I do agree that there is some room to increase the tax base, and that's what Ukraine needs to do. So actually, as I said, there is some efforts that Ukraine's authorities also have to think and have to make to improve the fiscal situation. But I generally disagree that we are so we are overestimating the risk of inflation or hyperinflation. The problem is that not only public finances, but also the central bank reserves and the demand for foreign currency, as we see it now. The collapse in economic activity was also accompanied by collapse in exports, and we cannot do anything to improve the situation now. So imports, of course, adjusted, but it's adjusted to the critical minimum that is needed to sustain the economy. Right. So, and there are also capital outflows. Like 7 million of people are out of Ukraine. They do spend their savings. We cannot stop them doing this. Yeah. So that will generate a humanitarian crisis in neighbor countries. And they do spend about $2 billion per month. Yeah. That's actually the trade deficit, the spending, and also capital outflows that do continue despite any capital controls and will continue, that all create a pressure on the currency and the pressure on central bank reserves. So now the NBU spends about $2.5 to $3 billion per month to maintain the fixed exchange rate. And this is covered by foreign support. We do appreciate each dollar that is coming now to the budget and to central bank reserves. This is support to our financial stability. Without the stability, I think it will be very difficult to win the war. And all this talks about the reconstruction, post-war economic policies have little sense now if you don't survive to this moment, right? So we do need international support also to maintain the stability on the FX market. Well, because devaluation doesn't help the economy in these circumstances. It does help in normal times. So there is an economic adjustment taking place because of devaluation. Exports is more competitive, imports is less, all this basic economic stuff. But we are in a different situation. Exports is basically a critical minimum that is allowed through the Black Sea ports, and it's a commodity exports. It doesn't adjust. So there is no way to increase exports via devaluation. So imports will also, again, a critical minimum that we have now. It will be, maybe the adjustment will be minimal, and capital outflows will continue, right? So money printing will fuel pressure on the currency, will fuel devaluation, will fuel inflation, and it may become a vicious circle without international support. I see that there is a kind of a remark. So let's, I don't know, you as a moderator, you decide what to do.
Yeah. Professor, would you like to give a quick response?
Can I quickly come back to you on this?
Sure.
There's no disagreement between us on this. I don't have all the information. And from the way you describe it, that's crystal clear to me and very convincing. The policy implication will, of course, be for the rich countries, especially of Western Europe, that are hosting Ukrainian refugees to pick up the bill. I don't quite see why Ukrainian refugees in Germany should support the German economy through transfers from Ukraine. That doesn't make a whole lot of sense to me. I really see this. It might be difficult politically. So what I'm saying is that two different things. One is quite clearly the Ukrainian economy is on life support and needs to be on life support, and that more needs to be done. So I'm in full agreement with you on this. The other thing is to say, what are possible exit strategies? I fully get that you're saying it's too soon to think about the post-war planning. From what I hear in Berlin, is for these people, it's not too soon. It's like the talk of the town right now. It is, of course, good to go back to them and tell them all the time. Let's face it, the Ukrainian economy is still on life support in this current situation. It's not at all over. So no agreement with you on or disagreement with you on this. I don't have all the information that you have.
Okay. Thank you very much. Deputy Governor, if I could just come back to you, just in terms, I think it's fair to say in the EPP, we've been very clear that the EU needs to do more to support Ukraine, both militarily and both economically as well. So I was just wondering, what more can the EU do to support the Ukrainian economy over the next 6 to 12 months? There's a lot of criticism coming from the United States. in terms of the disbursement, the speed of the disbursement of what the EU has agreed to. I think the EU has agreed in principle to match US funding for 2023 in terms of 1.5 billion per month to help close the immediate budget deficit. I suppose I just worry from my perspective here in Brussels that this could get caught up in political disagreements within the EU, given that it has to be approved generally by national parliaments, etc. So I was just wondering, from a Ukrainian central bank perspective, what is really critical for you over the next 12 months from an EU side?
Thank you very much for this question. But before answering directly to it, let me also reflect on the professor comments.
Sure.
And yeah, definitely we understand that we need to somehow to manage, the economy during this wartime. And definitely we understand that in some part we may rely on the inflation tax. Yeah, so that is one of the channels how we transfer the war effects on the population. And we understand that this suffering from the war, so we have somehow to redistribute it among different groups of economic agents. But what we definitely try to avoid, that is uncontrolled adjustment. And what we think that, and what we observe from different episodes of the wars in Europe, in other continents, so probably the worst way how you may do that is putting the economy in financial and macroeconomic disorder. So, and that's why we agree that inflation will be very high this year, 30%, around 20% next year in our forecast. So, and with frozen nominal incomes, nominal wages of the population, so actually that bring you very high, very strong, very strong decrease in the real disposable income of the population. Again, and we're ready to do the adjustment in this way. But again, so we don't want to have the prices increase with factor 5 or something like that. So definitely we think that we may completely undermine our resistance to the war. And in that respect, definitely the more financial support we receive from our partners, so the more ammunition we have to withstand to these war effects on the economy. And definitely the answer on your question is quite obvious. Yeah, definitely we expect much more support from EU, at least at the level our American partners already have provided us this year. So we should not forget that this war in Ukraine is not only attack on Ukraine but also on the whole Europe. So, and the system of Western liberal market democracy and rules-based global order. I suppose that Europe actually benefited a lot after the Second World War from this global order and peace secured by the agreements between the countries. And nowadays, definitely this order in a big danger. And definitely, in order to save this prosperity and the peace in the Europe, Ukraine has to win, not only on the military battlefield, but also in the Europe, on the economic front as well. So, and the war puts a sizable drag on the Ukrainian public finances, and Olena already mentioned that. I also mentioned that, and before the war, actually Ukraine conducted very orthodox fiscal policy and was able to bring debt to GDP ratio below 50% of the GDP, and this level was even lower compared with the pre-pandemic rates, and that was quite exceptional actually in the global context. So, but nowadays we definitely need the support from the partners. And frankly speaking, I don't think that we have to focus only on the funds provided by under, for example, macro financial assistance, which I suppose to be the main vehicles next year, and also we still have to receive some $3 billion this year. But also, I suppose that the support should come in other ways. For example, definitely the legal efforts have to be made to access frozen Russian assets for recovery needs. And the seizure of these funds requires the development of corresponding legal procedures, and we believe that these necessary steps have soon to be found how to approach these assets. And also, definitely, we also on the sanctions front, so already a lot has been done, but still there is the room to strengthen the pressure on the aggressor state. So in different fields, in the SWIFT, in the gas and oil caps, and so on. So all this to be done in order again to ensure the victory of Ukraine as soon as possible.
That's thank you, Deputy Governor, and you've actually answered one of the questions that came in advance about developing legal frameworks to utilize, frozen Russian assets to help with the reconstruction. Professor, I have one last question for you, which is, and this is why I'm a bit worried about the long-term response of the EU, because as you know, the EU loves these big, grand gestures, these big designs. And, in Brussels these days, there's a lot of very loose talk about, a Marshall Plan for Ukraine. But what I feel is that a lot of European policymakers don't realize is that, and please correct me if I'm wrong here, that the Marshall Plan, the debt relief provisions of the Marshall Plan were supposed to be temporary, and were supposed to be reactivated once Germany was reunified. But actually, the debt relief provisions became permanent, and they were never reactivated after unification. And what actually happened, as you mentioned, the currency stabilization, the currency reform in Germany in the 1950s or the late 40s, but actually, because of the Marshall Plan, we had a permanent debt write-off of pre-war German debt. And I'm not sure if that scale of debt relief is something that EU policymakers are actively considering at the moment, even though it was a key element of the Marshall Plan. I'd just be interested on how you view.
Okay, I would not go quite as far as you in attributing this to the Marshall Plan. Let me explain what the Marshall Plan exactly did. It gave a mixture of grants and credits to European recipient countries. That included West Germany, which was just back then being reconstructed as a state. Recipients of Marshall aid elsewhere in Europe were made to sign a waiver giving Marshall aid to Germany first charge over all other claims to Germany. Okay, so junior debt was being issued and was being made senior. So a reversal in seniority. The lawyers among our audience will understand this immediately. New debt was issued and was made senior. And then Marshall aid to Germany was blocked from repayment, which meant that temporarily all legacy debt of Germany was blocked. That, under the conditions of the 1950s, was probably absolutely critical in getting trade to go again. And it was one of the kind of accompanying measures of behind establishing the European Payments Union, which was securitized by American dollars. So the credits in the European Union. So it was basically protecting a debtor from legacy debt, and at the same time creating new trade credit, creating new working capital to make all these European economies go again. Now, what then actually happened to German legacy debt was it had been kept open by the Marshall Plan. It was not entirely clear what would happen, but then came the London Debt Agreement of 1951, 1952, which had a pretty surprising clause, and that surprising clause was saying that everything having to do with World War II legacy debt or Nazi debt would basically be relegated for a reparations or to a reparations conference to be held at the time of German reunification. Well, that reparations conference was never held. Now, there are, of course, 2 points of view on this. One is what I would call the Polish-Greek point of view, which is, wait a second, why don't we call this reparations conference? There's a lot of unpaid money here. And another view is the German view saying we have had all these current account surpluses for 40 years or 50 years or 60 years or 70 years. Do you want even more German current account surpluses? You see what they did under the target system in the Euro crisis. These are unwritten papers. What I would say just analytically, keep the Marshall Plan provisions, which was temporarily blocking legacy debt, keep that apart from the way that German legacy debt was actually dealt with. Because that would be different in any situation, in any post-war situation. I would venture the guess that, of course, at some point you needed that conference on Ukrainian legacy debt. And you need some rescheduling, some debt workout. What that is going to be, no idea. Simply because this depends on many, many factors that we will only know about, or parameters that we will only know about at the time we get to this conference, in so and so many years from now. We will know what Ukraine's accession status is to the European Union. We will know whether there has been currency stabilization, hopefully at a rate that makes Ukraine, at least for a while, competitive in exporting to Europe. All these things, we simply don't know what the current account status of Ukraine back then or then in the future is going to be. I would say the temporary blocking of debt under the Marshall Plan is nothing that would speak against having a debt workout in the future, and should not be against the Marshall Plan. Just an hour ago, I was actually on the stage here at this conference explaining to everybody that the Marshall Plan, in terms of its volume, was much, much lower, much smaller than what people in the conference room here seem to think. There's no way you would channel 300 billion plus. In the end, it may be much more than that. Through foreign existence. No, of course not. The trick, the microeconomic trick, the institutional trick behind the Marshall Plan was to provide recapitalization and working capital, and then basically let the Central European countries do their own reconstruction, which was a process that took 25 to 30 years. And I'd be very surprised if that's going to be fundamentally different in the Ukrainian case. Because if you get foreign aid to the tune of, let's say, 20-30% of GDP as credit, 40% of GDP as credit, and if you add to this commercial lending and direct investment to Ukraine, you would actually create the basis for a debt crisis. And I'd be quite worried about this. So what I'm saying to my interlocutors here is give as much as you want and even more to the Ukraine, but give it as grants and not as credit. Because repayment is going to be an issue. And when you start doing it as repayment, then actually create it under conditions that actually empowers and enables Ukraine to pay back. And I was explaining to people here that the Marshall Plan itself actually came only at the end of America's assistance programs to Europe throughout and after World War II. And it arrived at a point of crisis in 1947, when people in the American Congress were saying, hey, we're giving these billions to the Europeans and we see no economic effect. Now you better come up with a political program that explains to us how our billions are actually going to have a positive marginal product, so to speak. What is actually the political value added of these things? And that was the Marshall Plan. So the Marshall Plan had an outer shell, a sugar coating, that was another aid package, and it had an inner hardcore, and that was the microeconomics of the Marshall Plan, which was about creating institutional stability and the basis for self-sustained recovery.
Okay, thank you, Professor. That's very interesting, because I think there are points that are not completely understood in a lot of political circles. It's actually 2 p.m. already. I have to say that discussion went by very, very quickly. So what I would like to do is really, I just want to thank everybody for taking the time, Professor, and my friends and colleagues in Ukraine. We really appreciate you taking the time. You can be sure that the Martin Centre and the EPP in general will continue to push for more European assistance to Ukraine, and I think we will take as our strategy the recent quote from Kenneth Rogoff, the former chief economist of the IMF, who quite bluntly said, and I quote, that the Europeans should be paying way more. I don't care if they're in recession. Ukraine is a war where it is defending the borders of Europe. So I think let's hope that's such a strategy continues in the future. And with that, I thank you again, and I wrap up the event. Goodbye. Thank you.
Thank you and goodbye.